Hello, and thank you for joining us here on the Clarity Core. Today we'll be exploring the topic new. The great investment mindset, make money even when assets fall. Explained. When most people think about investing, they imagine buying something, a house, a stock, a coin, and waiting for its price to rise. That's the traditional way. But the greatest investors of all time think differently. They make money not only when prices go up, but also when prices fall. In fact, sometimes, knowing when something will lose value is even more powerful than predicting when it will go up. Today, we'll explore a powerful mindset, the great investor's mindset. We'll uncover how some of the world's smartest investors profit during crises, how to spot which assets might lose value in 2025, where the world's money is flowing now, and which strategies you can use to protect and grow your wealth. Let's begin. Part 1. The Great Investment Mindset, Making Money, Even When Assets Fall. Let's start with a simple truth. Every financial market moves in cycles, up and down. But while most people panic during downturns, great investors see opportunity. They understand one key principle. Price is temporary. Value is eternal. When prices fall, the opportunity rises. Here's an example that makes this idea crystal clear. Imagine you own a beach condo in a popular coastal town worth $500,000. Business has been great, but you get a credible warning. Tourism is about to collapse next year. New travel rules, plus rising mortgage rates, plus big oversupply. You don't panic. You act. You sell the condo today for $500,000. You park the cash in short-term safe assets, money market plus a short treasury fund, while you wait. A year later, tourism collapses exactly as predicted, and condo prices fall 50%. Similar condos now sell for $250,000. With your original $500,000 cash, you can now buy two comparable condos at $250,000 each. Result: you turned one asset into two by predicting and timing a decline. Not because the beach got better, but because you understood where value would move. Lesson: selling at the right time and holding cash lets you buy more when prices drop. In other words, you've doubled your money. Not because real estate prices went up, but because you understood how value moves between assets. That's the power of financial intelligence. It's not just about what you own. It's about when and where your money sits. Lessons from crises history has proven this time and time again. When the 2008 financial crisis hit, most investors were terrified. Stocks collapsed. Real estate crashed. But Warren Buffett saw opportunity. He invested billions in companies like Goldman Sachs, Bank of America, and Coca-Cola, when everyone else was selling. Similarly, Ka-Shing, one of Asia's richest men, bought up undervalued properties during the 1997 Asian financial crisis. Both men shared the same mindset. Be fearful when others are greedy, and greedy when others are fearful. That's not just a quote. It's a strategy. They understood that every crash brings with it a massive transfer of wealth, from those who panic to those who prepare. And that brings us to 2025, a year when understanding where value flows might be more important than ever. Part 2. Following the money. The 5 asset classes. Most at risk in 2025. To understand where opportunities lie, we first need to see which assets are losing value. In 2025, the global economy faces a massive shift in money flow. Confidence in the US dollar, the world's reserve currency, is beginning to waver. That change has deep consequences for almost every asset class. Let's explore 5 assets most likely to lose value in the next economic cycle, and why. 1. U.S. government bonds, the once safe haven, now under pressure. For decades, U.S. Treasury bonds were considered the safest asset in the world. They were the bedrock of the global financial system, the place where governments, banks, and pension funds stored their money. But today, that story is changing. Major countries like China and Japan, two of the biggest holders of U.S. debt, have started selling their bonds. Why? Because when the U.S. government borrows too much, the only way to attract new buyers is to raise interest rates. And when interest rates go up, bond prices go down. That means trillions of dollars of safe investments are quietly losing value, even as inflation eats away at the real returns. What was once the world's safest bet is now a ticking time bomb for global institutions. 2. Cash, especially local currencies. Holding cash used to feel secure. But in today's world, cash is one of the riskiest assets you can own. Why? Because its value depends entirely on trust, and that trust is fading. Across the world, we've seen national currencies lose massive value. The Japanese yen, once one of the strongest currencies, has plunged. The Argentine peso has been destroyed by inflation. When faith in a currency fades, its buying power collapses, quietly, then suddenly. And while you might still have the same number of notes in your hand, those notes buy half as much. That's the silent danger of inflation. Your money looks the same, but it's worth less every day. So holding too much cash, especially in unstable local currencies, might actually mean losing money while you sleep. 3. Financial markets dependent on bonds. Here's something few people realize. The entire global financial system is built on U.S. Treasury bonds. Banks, pension funds, insurance companies all rely on bonds as safe collateral. But if those bonds start losing value, the whole system shakes. That's exactly what we're starting to see. As interest rates rise, the value of bond portfolios falls. Banks then have to raise capital, sell assets, or cut lending, triggering chain reactions across stock markets and real estate. This is why rising bond yields often cause stock markets to drop, and why 2025 might bring more volatility than investors expect. 4. Dividend stocks, losing their shine. Dividend-paying stocks have long been favorites of conservative investors, but rising bond yields are changing the game. If a government bond now pays 5%, guaranteed, why would an investor take risk buying a stock that yields 3%? To stay competitive, dividend stocks have to fall in price until their yields match that 5%. That's basic math, and it means even solid companies could see their stock prices drop, not because they're bad businesses, but because money is flowing elsewhere. 5. Commercial real estate, the silent crisis. Finally, one of the biggest losers of this new era might be commercial real estate. After the pandemic, remote work became the norm. Office buildings across major cities, from San Francisco to New York, now sit half empty. Meanwhile, the rise of e-commerce has devastated shopping malls and retail centers. Property owners are struggling to pay their loans. Banks holding those mortgages are feeling the pressure. As vacancies rise and rental income drops, the value of these commercial properties falls, creating a slow-moving debt crisis that could ripple through the entire financial sector. Part 3. Where the money is flowing. The new safe havens. When old systems crack, money doesn't disappear. It moves. The question is, where? For decades, the global money cycle worked like this. The U.S. prints money, China sells goods and buys U.S. bonds. America keeps borrowing, the world keeps spinning. But that cycle is breaking. Now the U.S. isn't selling just bonds, it's selling confidence through strong economic data and stock market optimism. And while the headlines look positive, the world's biggest capitalists, like Warren Buffett, Mark Zuckerberg, and major hedge funds, are quietly doing the opposite. They're selling stocks and holding record levels of cash. So where are they planning to deploy that money next? Let's explore the 5 major destinations of smart money in 2025. 1. Gold and precious metals, the oldest safe haven. Whenever people lose faith in paper money, they run back to what's real: gold, silver, platinum. Gold isn't just shiny metal. It's trust in physical form. When the dollar weakens or inflation spikes, gold often rises sharply. That's why central banks, especially in Asia and the Middle East, have been buying record amounts of gold in recent years. It's the ultimate hedge against uncertainty. 2. Commodities and energy, the foundation of the real economy. While financial markets fluctuate, raw materials remain essential. Copper, lithium, and oil are the lifeblood of the global economy. As nations invest in green technology, electric vehicles, and renewable infrastructure, the demand for metals like lithium and copper will surge. Meanwhile, OPEC continues to control oil supply, keeping prices stable and profitable. Investing in commodities isn't glamorous, but it's fundamental, because no matter what happens to markets or currencies, the world still runs on energy. 3. Real estate in strategic locations. Not all real estate is doomed. Commercial buildings may suffer, but residential properties in developing high-growth areas remain valuable. Cities in Southeast Asia, Latin America, and parts of the U.S. Sunbelt are seeing rapid population growth and urbanization. Investing in property where people are moving, not fleeing, can still be a smart, long-term play. As always, real estate is about location, timing, and demand. 4. Technology and AI companies. In a world shifting toward automation, digital transformation, and artificial intelligence, tech remains one of the most promising frontiers. Leaders in AI, cloud computing, and data infrastructure, companies like NVIDIA, Microsoft, Google, and Tesla, are shaping the next industrial revolution. Even during economic downturns, innovation doesn't stop, and technology often recovers faster than traditional sectors. Investors who understand this cycle position themselves not just for survival, but for exponential growth. 5. Bitcoin and digital assets, the digital gold. And finally, we have the wild card: Bitcoin. Once dismissed as speculation, Bitcoin is increasingly viewed as digital gold, a decentralized store of value beyond the reach of governments and inflation. When inflation rises and currencies weaken, Bitcoin often surges as investors seek assets that can't be printed or devalued. It's volatile, yes, but in a world where trust in fiat money is fading, its long-term appeal is undeniable. Part 4. The Smart Investor's Playbook for 2025. Now that we've seen where the risks and opportunities lie, let's translate this knowledge into action. Here are 4 key principles that define the great investor's mindset for 2025. 1. Don't hold too much cash. Remember, cash is not wealth. It's a temporary store of value. When inflation is high and interest rates are unstable, cash quietly loses purchasing power. Keep enough for safety and opportunity, but not so much that you become a victim of devaluation. The rich don't hoard money. They move it into assets that grow or hold value. 2. Don't follow the crowd. In every market cycle, there's a moment when fear and greed collide. The crowd panics, headlines scream, and everyone runs for the exits. That's when the great investors act. As Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." When the market crashes, that's not the end. It's often the beginning of the next wealth transfer. The brave buy what the fearful sell. 3. Think in cycles, not moments. Nothing rises forever. Nothing crashes forever. Every market, every asset, every economy moves in cycles: expansion, correction, recovery. The key is to recognize where you are in the cycle and position accordingly. When prices fall, that's the seed of the next bull market. When prices soar uncontrollably, that's the whisper of the next collapse. Investors who understand this rhythm never get lost in the noise. 4. Always have an exit plan. Even the best investment can turn against you. That's why smart investors never go in without knowing how they'll get out. Diversify your portfolio, set stop-loss limits, and don't marry your assets. Marry your strategy. Because in volatile times, flexibility is your greatest strength. Final thoughts. Seeing with the third eye of money. In 2025, the winners won't be those who predict every move of the market, but those who understand the movement of money itself. Money is not a thing. It's a verb. It flows, it moves, it transforms. It gains value when it can buy what others desire. It loses value when trust disappears. So open what some call the third eye of money, the ability to see beyond price tags and headlines and into the flow of value itself. Because when you can see money move, you can position yourself ahead of it. And that's where wealth is truly created. The world is shifting. Currencies are losing power. Markets are changing shape. But those who stay calm, informed, and strategic will not only survive, they will thrive. As history shows, the greatest fortunes are not made during booms. They are built quietly during crises. So, in this new era, remember, price is temporary, value is eternal, fear creates opportunity, and money always finds the hands of those who understand it best. If you found this video helpful, hit like, subscribe, and turn on notifications. This is the Clarity Core, helping you see the world through the eyes of great investors and build lasting wealth, one insight at a time.